So, hello everyone and welcome. We always take a couple of minutes to chill because people don't jump in right away. For shame. They should be here waiting for us. That's how it should go, right? But today, well, this whole month we're talking all about first time home buyers. But before you can do anything, you need money, right? You can't just go to the grocery store and hope for the best. You've got to come prepared a little bit. Buying a house is a little bit bigger and kind of the same. So before we talk about all of the other stuff next week in terms of what else you got to do, we're going to spend probably way too much time teaching you more than what you need to know about how to buy a home. And we brought a special guest that knows way more about the money than I do because he takes care of that part. I just help you spend it. So take a minute to introduce yourself.
Hi, everyone. My name is Joseph from Open House Finance. Yeah, I'm a local lender, mortgage broker, whatever you want to call me. Basically, as a mortgage broker, I work with 200 plus lenders to help find the best rates and best product to suit your scenario. Everybody's different. Everybody has different credit scores, different DTIs, all that. And different programs you're aiming for, and so I try to find the best one that fits your needs. So yeah, that's kind of my role, high level.
And we're going to get into the weeds and all of that because it's the most confusing, nerve-wracking, all that type of stuff. Part of this whole thing. When I first joined this industry, I had a very old lender who'd been doing this since the dawn of time say that getting a pre-approval and getting a loan feels like someone is stripping you naked and looking at everything. And I hope it's not quite that bad. It felt a little bit invasive when I did it, but he had a lot of practice and probably said that way too many times. So we're going to break this down and make it less scary, right? So overall, we're first going to talk about what it takes to get pre-approved and what that means. Then we're going to get into loan types and what might be good for you in your situation. We'll then go into roughly or some stories on deal breakers to kind of have a break and talk about some funny, crazy things that I've seen people do, that you've seen people do. Not to say that it's too funny because it is what's really happened to people, but also let's not do these things, right? So if you do happen to be one of these stories and you're watching, I'm sorry. It's to help everyone else not go through that, right? Uh, then we're going to go into common mistakes that kill deals so that you don't have to make them. And we'll go into a little bit on property condition because we get a lot of questions about property condition and what they can and cannot buy. It's really confusing. And if we have some time at the end, we'll go through some questions. All depends on how many people join in and what all's going on. So let's start out with, where did we go? What does a pre-approval letter mean? What's going on? What are the types?
Yeah, so I mean, there's different phases, right? Depending on how invasive you want to get. Usually when I first talk to a potential borrower, I'd basically ask them how much they make, what their estimated credit score is, and we kind of go from there, and I can estimate how much they can afford. This is the least invasive kind of what we call a pre-qualification. However, these days, most agents, probably including yourself, Brian, will want a pre-approval letter from someone like me so that they can know for sure how much they can afford. That would be like the second phase. I would pull a credit, usually soft credit pull, so it doesn't affect your credit score. I would actually look at your income docs. I would look at your W-2s. I would look at your current pay stubs. And potentially your tax statements as well. When I do pull your credit, a soft pull again, I'll see your debts and everything, and then I can kind of run some numbers and see your debt to income ratio and see what you actually qualify for based on your debt to income ratio and your credit score combined.
So just to kind of clarify a little bit,
yeah.
So there's pre-qualification, then pre-approval, right? And a pre-qualification is kind of like a trust me bro, right? Because you haven't run anything, you haven't looked at anything. So there's a lot of dreams there, but it's really just rough numbers, right?
Correct.
So if we actually want to like check some stuff, because I know pre-approval still misses stuff, it's not perfect, right? So pre-approval is actually running their credit. think I'm starting to lose you a little bit. There it goes.
Yep, I'm back. Sorry.
Okay, so pre-approval, we're actually running credit?
Yeah, pre-approval, usually a soft pull, unless you're within a couple of months. If you're kind of I'm just kind of browsing, then we usually do soft pull so it doesn't affect your credit score. If you're a little bit closer in timeline, we'll do a hard pull because I don't want to have to pull it again. And then, that just costs more money. So, yeah.
So if we're doing a pre-approval and we're running credit, one of the biggest questions I get all the time is, well, I don't want you to pull my credit because what if I'm not ready, right? So I guess two big parts of this question. First, if we do a credit check, are they able to check more than one place, or are they getting 10 pulls and now their credit is 0?
So that's why we do a soft pull when you're not ready, because it doesn't affect your credit score when you do a soft pull. I can grab all the debts. I can grab the credit score. And we can do as little as 1 credit bureau, or 2. Usually I do 2. That's kind of the cheapest way to still make sure we get the middle credit score, because what we go by will be the middle score out of the 3, right? And so if you're just, like I said, if you're just in the, I'm not sure if I'm ready to buy a house, I want to see what I could potentially qualify for, we'll do a soft pull.
Okay, and if they get a pre-approval letter, how long do those usually last? How long are they good for?
As long as the credit score lasts, which is around 120 days.
Awesome. So we get the pre-approval letter, and what is, when they go super crazy, what is pre-underwritten? What does that mean?
Yeah, so that's when we actually submit the file to the lender/underwriter. We will actually submit W-2s. We will submit pay stubs. We will submit bank statements, credit score, obviously. We will do a full hard pull if we haven't already. And that's usually kind of the start of the underwriting process. This is usually enough unless you're self-employed. If you're self-employed or own other investment properties, we'll also need tax returns as well. This is kind of the minimum needed to submit to underwriting and get what they call an approval with conditions. If you get an approval with conditions, that means you're, based on everything they see so far, you're going to qualify as long as you didn't, lie anywhere or fudge anything. They might ask for oh, we need a verification of employment, like a letter or something. But I mean, if you're telling the truth in the beginning, that shouldn't come, right? So once you get to this point, I'd say we're about 75% there. We just got to kind of cross some T's and dot some I's from that point.
So from the realtor perspective, if we get an offer that has a pre-qualification, it means that really it hasn't really been looked at, right? It means it's really rough, and that's a really rough offer to accept. We like to see pre-approval because that means that we have some hope that we'll be able to close, that it's been looked at relatively well. And if a client comes in with a pre-underwriting, that means we're probably going to close in general. At least from my side. I don't know how you feel about it.
I feel pretty confident once we get to the pre-approval stage. Obviously, underwriter has a little more tools than I do, can maybe to see verification of employment, that kind of thing initially. But I, as a lender, feel pretty confident if you go through my pre-approval process. As a realtor, I understand that maybe you want the pre-underwriting, but not all lenders are gonna underwrite you without a property. So that's where kind of the disconnect will come in play.
That's the big challenge for everything as a realtor, is that we're just kind of cavemanning our way through it. Like, what's the basic part, right? Versus inspectors, appraisers, you have to actually know exactly what's going on. And why it's so nice to have you on as a guest.
Yeah, another key thing to kind of keep in mind is locking a rate too. I would say most lenders won't let you lock a rate until you have a property under contract. And so obviously the rate is going to go up and down depending on the day. And therefore your payment goes up and down depending on the day. Therefore your qualification goes up and down depending on the day. So that kind of throws a wrench in things as well. And so that's why pre-approval is usually enough. But obviously pre-underwritten is more of a gold standard, but it's hard to get without the property.
So if someone wants to get a pre-approval letter, what documents should they usually have ready?
Yeah, so if you're a salaried employee and you're guaranteed to make a certain amount per year, per month, all we really need is the 2 most recent pay stubs, the last 2 years of W-2s, bank statements to show enough funds to cover closing costs and down payment. and then a credit report, which is something I handle. So that's the minimum for a salaried employee. If you are an hourly employee or want to use commission and bonuses in your qualifying income, on top of that, you'll need the final W-2s of the last 2 years. That way we can kind of see how much you made from bonus or commission or your hourly rate. And then we would take all that and divide it by 24. So basically, if you're salaried, we'll use your salary. If your income is more variable, we're going to average it out over the last 24 months.
So if someone wants to buy a home and they're thinking about starting this whole thing, how far in advance should they reach out to you?
Well, I would suggest you get pre-qualified at minimum before you even look at a house, because how do you know what house to look at if you don't know how much you can qualify for? And basically, your job gets a lot easier once you know exactly how much your client's going to qualify for, or else you have no idea. I mean, we can kind of guess, but that's not really helpful for you.
So in my experience, and it might vary, everyone's got different tolerances for things, but I like my clients to reach out as far in advance as possible, because what'll happen really often is we'll find out that they have some payment they got to get rid of, or some credit card they got to pay off, or maybe they need to open a line of credit, which sounds crazy, but maybe they're like, hey, I'm ready, and they've got no credit, right? So I definitely, before we start shopping, that is a great time. But sometimes if it's like 3 months, 6 months before, just to double check and be like, hey, maybe we got to pay off the Visa card. That can be a big difference. And it can make a big difference on the loan too, because sometimes you pay some stuff off and it's like, hey, the rate's lower now, or maybe you qualify for more home, and it can be a big difference.
Yeah, you bring up a really good point. An interesting thing about credit card lines that are open is that Amex lines really throw a wrench into qualification. While they're considered an open credit line, their minimum monthly payment is actually the full balance. And so a lot of my borrowers come with this Amex and they're like, yeah, I have this Amex. It has like $1,000 balance on it. And we pull the credit report and it says $1,000 balance and $1,000 minimum monthly payment, which means that's $1,000 of qualifying income taken away. And so it's very easy to just pay that off. And we can even pay that off at closing, not a big deal. But some things like that, yeah, you bring up a very good point. We need to take care of it at the time, or at least understand it.
So long story short, for the folks at home, if you can, before we buy, we want a pre-approval. But as a rough number, pre-qual is okay. We are going to have to look at some bank statements, some tax returns, nothing too crazy, but definitely going to need to look at more than a few things, because believe it or not, people won't just write you a check for $500,000. You've got to show you can pay that off is all they're really doing.
100%.
So, ready to talk about loan types?
Yes, sir. Let's bring it.
What types of loans are there?
Well, there's a lot, but we can go through the basics today. Let's start with conventional loans. So conventional loans are the most popular. It doesn't have necessarily the best rates, but it does have the least amount of upfront costs. So a lot of people think to get a conventional, you need 20% down. That's not true. First-time home buyers can go as low as 3%. If you qualify, depending on your income, you could qualify for Home Ready, Home Possible. These are programs through Fannie Mae and Freddie Mac. You could also go as low as 3% on those. And so conventional doesn't have any like those random upfront costs that the other government loans will have, like VA or FHA. And so a lot of people like conventional because, yeah, it might be about 0.5% higher. However, there's not this like 2% upfront cost or 1.75% upfront cost like in FHA. And so these are kind of I call it the cleanest loan. They're also the most lenient in terms of appraisal, because they're not going to be as stickler on the condition of the property. Of course, it needs to be livable and all that, but they're not going to look at peeling paint and kill the whole thing. And so conventional is usually, if you qualify, is the way to go. However, to qualify, you usually need it's around 680 credit score and above, of course. And even for 700 it's going to be kind of close, depending on how much you're going to put down, how much your debt to income is, and every case is going to be different. But conventional is basically the gold standard of loans that most people want.
So if they do not have 3% down, are there options?
With conventional, there's not a lot of no down payment options conventional. There are with FHA, and we can kind of go into FHA in a sec, but I would say with conventional, you're gonna need that 3% down. It's really tough to do it without.
Absolutely. So if they don't have it, what's the best next best option?
So there's two next best options depending on if you're military or not. We'll go with FHA first, which you don't need to be military. You can be anybody with this. FHA is best for because it's the most lenient in terms of standards, underwriting standards, debt to income standards. You can go above 50% debt to income in FHA. See it all the time. The down payment, a lot of lenders offer kind of a down payment assistance program. Because the minimum down payment for an FHA, but you can get a lender to cover that 3.5% as well. You might need to come up with closing costs, or we can kind of figure out ways to cover closing costs through seller credit. That's something you can work with Brian about. But FHA is best for those with below 700 credit scores. There's some positives to FHA though. The rate is usually lower, about 0.5% lower than conventional. However, the big negative of FHA is what they call upfront mortgage insurance premium, upfront MIP, and that is about 1.75%. And so of the loan amount. And so basically you're adding 1.75% to the loan amount right away. And so, it's basically your price for purchase went up 1.75%, which is kind of a bummer, but that's kind of the downside of FHA and all these more lenient standards. The one thing about FHA that's not lenient is the appraisal, which I alluded to earlier. I've seen some FHA deals die because of the appraisal. They really are sticklers when it comes to the condition of the property. It has to be very, very safe, is what they're looking for. While conventional appraisals, it just has to kind of meet market values and be livable. So there's a big difference there between getting a value based on the market and being safe. And FHA leans on being safe.
So kind of on that similar note, before we get to VA, because VA is awesome, but for a more niche group of folks, what about USDA? Is that zero down too?
USDA is zero down. However, you will have to come up with the closing costs. And closing costs, it's impossible for me to pick a number because it depends on the price of the property, right? But yes, USDA usually geared toward rural, actually definitely geared toward rural. So it's kind of, in your neck of the woods, it's probably a little more prevalent than where I'm living, which is the Seattle area. So I'm putting up a map
right now, not to interrupt too much, but this map shows in the yellow areas where you cannot do USDA in our area here. So, up where you're at, Seattle, a little harder, but for my turf, which is roughly here, pretty much everybody can do USDA.
Yeah, USDA is a good option if it qualifies, There is no down payment minimum, but you will have to cover closing costs unless it appraises for higher than the purchase value, which could happen. And if it appraises for higher, you could take a loan amount up to the appraisal amount to cover the closing cost difference. There are some downsides to the USDA. One is the upfront funding fee as well, similar to an FHA, similar to a VA. It's about 1%, I believe. Don't quote me on that, but I believe 1%. On top of that, there is an annual funding fee as well. I believe don't quote me on this, I think it's like 0.5% or something like that. I don't remember off the top of my head. So basically, you're paying upfront for the opportunity to put zero down to qualify for USDA, and then you're also going to pay yearly as well.
So, long story short, for the folks so far, is that conventional is going to be usually, in my opinion, the best for most folks if you can swing it. But if you're having some, little lower credit, little lower down, I think that FHA and USDA are really strong options that may be even better than conventional. Nothing wrong with going with any of them, but from the realtor perspective, conventional loans tend to be favored a little bit higher on offers than FHA or USDA or even VA. I would say it's probably pretty close tie between FHA and USDA. VAs tend to get picked on a little bit more. But tell us about VA loans.
VA loans. So I lived in Hawaii for a decent amount of time. And VAs are very popular in Hawaii because, at least on Oahu, a lot of military coming to the island and purchasing property. And VAs love it because they can come to Hawaii, they can buy a beautiful home with zero down, and get an amazing rate. Unlike FHA, where you're getting an amazing rate, but you got to have this. You got to come up with 3.5%. VA, you don't have to come up with anything up front. However, you got to be military, or at one time you were military, so you got to qualify. There is a downside to VA, is there's an upfront funding fee as well. That funding fee, if it's your first time, it's 2.15%. If it's your subsequent time using your VA eligibility, 3.3%. So there's to get upfront investment. That can be rolled into the loan. However, similar to FHA, closing costs, if you're putting zero down, you can't roll the other closing costs of the loan. So you will have to come up with a little bit of money to cover those closing costs. And again, if you can work with Brian to get seller credits and that kind of thing to cover everything, so you come in with zero. Again, VA is very niche though. However, it's probably the most I would say kind of the best program to take advantage of if you qualify.
If someone has a VA, I think that they pretty much always use it. I mean, I could be wrong, but I think it's pretty much always the best deal. In terms of the VA loan itself, what's really cool is that most of the fees you are not allowed to even pay for. So it's in other types of loans, you have to haggle and negotiate on who's paying what. With VA, it's just kind of done. You just can't do it. It's just not allowed. The biggest challenge with it is condition, which we'll get into a little bit. Of the home has to be really nice, but also it's good to move into a really nice home. But if you are a veteran, the VA is pretty much always a slam dunk, in my opinion. There may be exceptions, but I haven't seen any personally.
Yeah, if VAs are great. So I see a lot of people use VAs. When I was kind of helping the military community more, they would buy something zero down. 3 years later, typical military, they would move. They would then go buy something else zero down. They would keep the other one, and then they would just collect houses with basically zero down. And so it's a pretty nice way to keep collecting houses every few years.
So on that same note, when it comes to first-time buyer programs, can you be a first-time buyer more than once?
No.
There are exceptions. There are exceptions. As far as I know, you can use a first-time home buyer grant as long as you are upgrading. So if you're going from like a condo to a bigger house, I believe you can use it more than once.
I'll have to look up that. I don't have the guidelines in front of me, so I'll have to look that up. But I've never seen a case where that. I've never run into a case where that's needed. Yeah, I should say.
Totally okay. But for a lot of these programs, my point mostly is that for a lot of these programs, even if you think you don't qualify, I think that a lot of people will be surprised. So, as we're going through these, you might think, oh, this isn't for me, right? I mean, there's going to be a whole live just on VA and on other programs like this, because a lot of people that don't think they qualify for VA, they actually do, because there's spouses or there's other exceptions that may or may not qualify. So the biggest thing for you consumers at home is, even if you have ideas of like, hey, maybe I do need 20% or maybe something else is going on, ask, because you might be surprised by what you qualify for and pleasantly surprised by how well this all actually can go. In terms of Washington, what specific stuff is going on in Washington to help buyers?
There are definitely some. I don't know. I don't have the programs in front of me, but there are definitely some programs that help with first-time homebuyers and down payment assistance. Some of them are like grants where they're forgivable. I can even offer some, just not necessarily Washington specific, that are forgivable. A lot of them are more like assistance where you're kind of paying them back slowly over time. And so there's a few different programs, and it just depends on how much you make. First time home buyer, there's all sorts of stuff, right? And it's impossible for me to pick one and say you qualify for that unless I understand the details of the situation. But there are ways to get houses with zero down. There's a lot of ways to get houses with zero down. Is kind of long story short. It just depends on you and your specific scenario.
My personal, not that this is necessarily like a bragging thing. I'm super happy for them, and in hindsight, I mean, they probably have a 3% rate on a $200,000 house. So they're probably very happy now, right? At the time they were nervous, but they only had $500 to their name. We got them credits and we got them the down payment assistance program. We combined everything together. Less than $1,000 and they bought a house. Now, modern day with a $450 price and all that stuff bundled, that payment's going to feel really high. It felt really high back then too. But, again, $200,000 house with probably a 3% rate right now. They were sweating back then, but they are so happy today. So I don't want people to feel like they can't do it. There's going to be some income limits. There's going to be, obviously, the math has to math, right? But don't take, there's so many programs here to help you. That the lesson and the real moral of the story here is that if you want to try, let's run some numbers. There might be something there, a program that'll fit what you're trying to do.
Agreed. Yeah, there's multiple ways. Somebody like me can definitely help you explore the different ways to do it. There's just so many that it's like impossible for me to name them right now and just understand, right? Because it's gonna be so personal. But yes, there's ways to go very, very little down or nothing at all.
But on that same note of hope, let's crush it for a second, okay? Let's talk about some deal breakers. What are things that are just going to hey, you've got to fix your stuff before we can proceed?
So the debt to income is there's two things. Credit on my side, there's two major ones: credit score and debt to income. And so credit score, I mean, anything under 600 is going to be difficult. Not impossible, but difficult. Anything under 500 is pretty much impossible. So there's ways to fix your credit score. Don't get me wrong. Let's say you start the process very, very early, and we're talking, and I do a soft pull, and I see it's under 500. What I could do is what they call a score simulator. And we can kind of mess around with what you need to pay off to see what the score jumps to. And something like that can really help a lot of different potential buyers get their credit score up to above 500, above 600, whatever we're aiming for. And so that's the first thing we can try to fix.
So on the subject of credit scores, here's something I come across a lot. People will look at their wherever they're pulling it from. I think usually their bank, right? And it'll be whatever, let's say 600. And then you run their credit score and you come back and you go, any idea what that's about?
Yeah, so the bank is more of an estimate. It's not the actual credit pull from. They're getting an estimate from the credit company, but it's not the actual one. And on top of that, for whatever and the actual credit pull I do through the actual TransUnion, et cetera, it's up to the second updated, and so. I've seen it where people think their credit score is one thing and I pull and it's higher. And I've seen it where people think their credit score is one thing and I pull and it's lower. And so so that's why I always suggest that we do a soft pull if you're not sure. I will say the most accurate one I've seen that's kind of quote unquote free is myfico.com. Again, not 100% accurate, but the most accurate I've seen. So if you're like, I don't want to pull my credit, I don't want to whatever, and you just want to get a score that's close enough, then I would go to myfico.com. However, if you pull let's say you pull like a 750, I mean, there's no way it's going to be that much lower than 750 as an example, right? But if you're pulling like a 500, then that's where it's borderline, and we got to kind of do a real tough pull to see what you're actually at.
So if we're looking at kind of a minimum bar and also a like, hey, this is where rates and stuff are good, what would you say? And again, it's going to depend, right? But as like an ish, whereabout should you be to be like, hey, it's possible, and where should we be at to be like, you know what, we're going to get you a decent deal?
Okay, so the best credit score you could possibly get in terms of in the lender's eyes is 780. That's going to qualify you for conventional, get you the best rate, right? And then every 40 points from there, roughly, give or take, maybe 20 points, depends. The rate kind of goes up from there all the way down in a conventional. Once you hit about 700 or lower, I would start thinking about FHA. FHA, as long as you're above around 500, 520, then you should be good for an FHA. Obviously, the rate corresponds with the score. And FHA is a little more lax, though, where, if you're above 600, you're probably going to get one of the best FHA rates. And then below 600 is probably where you're going to get a lower one. And so it's, those are kind of the benchmarks. VA, yes, I mean, 780 is going to get you the best, and then it's just going to kind of drop down from there every 40 points or so. So that's high level.
Okay. So the next thing that could kill it is debt to income, right? So what does that mean, and how does that work?
So debt to income is basically the how much you make divided, all your debts combined, including the new one that you're about to take on. That's also including, so that's principal, interest, taxes, insurance, and potentially HOA, if HOA applies. You will, and you add that to all your other debts. And when I say other debts, I don't mean the whole balance. I just mean the minimum. So the minimum payment. So if you have a $5,000 balance on your Visa, the minimum payment's $120. We only calculate $120. So we add that all together, and we divide it by how much you make per month. And the definition of how much you make per month can be very straightforward if you're salary, or it can be a little difficult if you're hourly or commission or bonus based. And that's something we can kind of go into later. However, let's just say you make $10,000. And all your debts, including the new one that you're about to take on, is $4,000. You divide 4,000 by 10,000, 40% basically, and that's your debt to income ratio.
So what kind of debt to income ratio do people need to have to qualify?
Yeah, so conventional, you're gonna need less than 50%. I've seen it push right up against that 50%, but I've never seen anything above 50% for conventional. For FHA, we can go over 50% a little bit. I've seen as high as close to 60, but nothing over 60 that I've seen yet. However, with FHA, another ratio comes into play. It's called the front end ratio or housing expense ratio. Although with all your debts combined, debt to income ratio can go over 50%. Your just housing ratio, that's just the new housing payment, which is principal, interest, taxes, insurance, and potentially HOA, divided by how much you make per month, cannot go above around 47%. So with FHA, there's two ratios that are in play. And
so as a rough number,
go ahead.
As a rough number, we don't want you spending more than half of your money on stuff you have to pay for, right? So again, what's really tough, scary with debts is that if you have $100 debt, it's not a lot of money, but that is a lot of house, right? Because you're taking $100 a month off of the maximum mortgage that you can get. And HOAs and flood, all that type of stuff is also going to influence that. So as a very fun example, it wasn't my client, it was a buyer buying one of my homes, which was a lot of fun. They took every single thing in their life and they put it on a payment plan. I'm talking couches, I'm talking TVs, I'm talking cell phones, right? And we got it done, but each one of those things is a monthly payment that may or may not be counting against how much maximum mortgage you can have. So the less payments you have, the more house you're qualified for, easier it'll be. If you are already spending half the money you bring in on your Visa card, on your whatever, you might not qualify for anything, right? You might have some cars to pay off, some old debts to pay off, right?
Yeah.
So what about money movement? One of my favorites is being partway through a deal and all of a sudden someone goes, "Hey, I got the money." And you look at the account and now there's $50,000 there. And you go, "What'd you do?" And they go, is that okay?
Sorry, what do you mean? Like $50,000 just randomly showed up?
It's in the account. We can do the deal, man. We got this.
Okay, yeah. So there's something lenders like to see called seasoning periods. Basically, it's 2 months or two statements to be perfectly exact, right? If that balance of $50,000 was there 2 statements ago, we can use it. However, if suddenly it's 100K in there after one, so let's say you go back 2 statements and then only after 1 statement, now it's 100K, then the lenders are going to question that, and that's because they don't want like you to take on a different loan, like a personal loan or some under the table loan that will affect your ability to repay the house. And so basically, I say if you can source it, like, oh, I sold my car, and you have the paperwork to show that that 50K came from something real and legal, then that's totally fine. If you get a gift, that's fine too, as long as you can source it. You'll need a letter from whoever gave. It has to be a family member. Sorry, it has to be a family member from a family member. So sign and say, "Hey, I gave you this," and then like a check. Maybe they'll ask for the check to prove that it came in from that person. That's fine too. But if you did some backdoor deal to take some money to buy the house, that's what they're planning to stop.
What if you're just taking a little bit of money every month, shoving it in your mattress, and you're so excited. You take all of it, put it in the bank. Let's do this.
Yeah. So that's the problem, right? I mean, if you're only putting in like $5,000 when you already had a $50,000 balance, you're going to be fine. However, if it's like suddenly you plop in, over 50%, basically is the rule of thumb. So next thing you know, you pop in $26,000 out of nowhere. You can't source it, and that's why you should never hide things under your your mattress, because you can't source it, right? What lenders want is just to see that it came from somewhere legitimate. That's just the idea, right? If it's been in your mattress the whole time, they have no idea if that's legitimate or not. It might totally be legitimate, right? And you were just socking away money the whole time, but you can't prove it. Therefore, they can't use it. Just because it happened. So something to keep in mind, though, just because you put in $50,000 doesn't mean it's going to kill the deal, right? They just can't use it, right? Maybe you're planning to put 10% down and you thought you could use that 50K for the 10% down. Now you can't use that 50K. Well, let's just lower your down payment. Of course, that affects everything else, and there might be a domino effect. But it doesn't kill the deal completely. It just means you can't use those funds.
Perfect. So let's talk about, on that same note, aside from just deal breakers, some common mistakes that kill deals. So I've got a couple that I've seen way more than once. And this is, again, if she's watching, I'm sorry. This is one of the most heartbreaking things ever happened to me. I had this client that was a head nurse, and we were going to COVID. This was in 2020. And she was so excited because she just got a huge promotion. They promoted her to upper management, and they switched her from W-2 to 1099. Congratulations. Is that going to fly?
Yeah, that's well, it depends how much job history you have prior. I would never ever recommend you change jobs in the middle of a transaction. What lenders like to see basically is stability. It just basically comes down to that. And changing from W-2 to 1099 changes the type of income you receive. So that's no longer stable. And therefore, that could definitely kill the deal. And it probably will. I mean, sometimes we can get around it, but usually not. I would never, ever recommend it. But if you do change to 1099, we want to see 2-year history of that. So that's kind of the problem also. So anytime anybody goes from either changes or goes from W-2 to 1099, you need that 2-year history again. There are programs that you can get away with 1-year history. Conventionally, you could put a pen, maybe get away with 1-year history. Maybe, very good, maybe. or there's non-QM programs out there you can do it. Bank statement programs. There's all sorts of ways to get lending. You're just not going to get the great rates like through a conventional, and you're not going to get away with 3% down.
So let's rattle off some do nots, right? Do you want to rattle off a list of do nots, or should I start chipping away and see what you think?
I mean, for me, it's just one rule. It's like, do not mess with your credit score or anything on your credit. The word credit, just don't mess with it. That's my golden rule.
Yeah. So super common things that I see is people, whether it is getting so excited to buy their new house that I don't know how people do this because it's weird from my perspective, but they're so excited to buy their house that they buy a new car to put in the garage, or new furniture, or any other appliances, things like that. No new credit, which is again in that same line, because a lot of people will be at Home Depot so excited and they'll be like, do you want the Home Depot card? And they go, absolutely. And that's trouble, right?
Yeah. Lenders put debt monitoring. If you're in the underwriting process, the lender will put on debt monitoring, and that thing is good. Like, it does its job. And anybody who opens any line of credit, it's going to get flagged. And you're immediately going to have to explain it and say, I did not spend a penny on it. Please forgive me.
And not just opening, but closing, right? Because we get people that are like, we're being so good. We paid off all those old credit cards, got rid of them.
Yeah. Yeah. Just anything with your credit. Just like, if you're pre-approved, just like hold off for 30 days and just, hang tight. After it closes, do whatever you want. It's, it's no longer our business anymore, but just get through those 30 days.
So just in general, as a general blanket statement, just like he's saying, whatever like snapshot you have when you start the process, just leave it there. Just don't spend anything crazy. Don't close anything crazy. If the lender says, hey, we got to change something, cool. But for the most part, whatever you got, just have a frugal month when you're buying your house. Just, hey, we're going to cook at home for 30 days. We're not buying anything new. And if it is over a couple $100, tell the lender, ask the lender. If you're going to deposit more, tell the lender, ask the lender. I get people that are self-employed too, that like they're buying a house, they got to get their down payment. And then they start like collecting their debts because they have like outstanding balances, and all of a sudden the bank account's like $30,000 heavier or something. And it's like, what happened? Gotta just make sure you're telling the lender, right? Like, no big changes unless we're running it by people.
Yeah, no job changes, no. I mean, position changes are fine as long as it's still in the same industry. You're going to be fine. But when it comes to jobs and stuff, they will do a verification of employment at the last possible minute before the loan closes. And anything that kind of like if you're suddenly not making the same amount, changing job titles, they will ask for details. I mean, if you get promotion, great. Obviously, take the promotion, right? Mm-hmm. That's a good thing. But don't like switch from, I don't know, secretary to janitor. Sorry, I'm just throwing out things out there, right?
Yeah. No, it was funny for me because I'm self-employed, and they kept on calling being like, does Brian still work for you? And I'm like, yes. And they're like, okay. And they would hang up. And it was like, okay, guys, sounds good. So if you are a 1099, you got to have 2 years history, right?
Correct.
For W-2, do you need any history?
Yes. So lenders prefer 2-year history as well. So the nice thing about W-2 over 1099 is with W-2, assuming you're a salaried employee, they'll just use whatever you make today, basically, right? If you make $100,000 a year, even if you made $50,000 a year last week and you make $100,000 a year today, as long as your employer will sign off on a letter or something, they'll use $100,000. However, if you're 1099, they're going to go by 2 years history and average it out. So we'll have to take a look at your tax statements and everything you do there and average it all out based on 1099 data.
So now that we're done with some of the most sad parts, I want to talk about the part that I think breaks my client's heart the most, which is property condition. Okay. So what is super common when people are buying homes, they're going to stretch their budget. And when you're stretching your budget, you're going to come across some home that needs a lot of work, and you're going to go, hey, I'm so excited. And as your realtor, I'm excited for you too. And then we look, and then you go, can I have it? And I'm a chicken because, of course, I could say, no, you can't. But what's way more common for me is for me to look at it and go, the house is cool, but I'm not sure your lender is going to like this very much, right? And this is actually one of my listings right now. It's cash only, and everyone goes, "Well, why is it cash only?" And it's like, well, I just don't think a bank is going to finance this, right? So, tell me more about what we should be looking for in a home and what makes it financeable or not.
Yeah. So, and on the lending side, I don't go to the properties ever. Very rarely do I ever go to the properties. I look at appraisal reports all the time, though. And so for all loans, the minimum standard is going to be livable, right? And the thing is, livable is not a very clear definition. And it's hard to kind of know exactly what the appraiser is going to say when it comes to livable or not, but it has to be livable. I mean, Brian, you probably have more experience than you see more houses, way more houses than me, and you could probably define that way better than me. But basically, conventional loan.
People live in weird stuff, man.
Yeah, sure. You're going to have to pass that livable bar for sure. This is conventional. We're strictly only talking conventional, right? It's going to have that livable bar for sure. If there are things that are like broken, for example, I ran into an issue recently on a refinance where the patio steps, a few of them were broken or rotting. Those had to get replaced, right? But the nice thing about conventional appraisal is they'll come back with an as-is price, and they'll come with a subject to price. And usually we want that subject to price. And so usually it's just some fixes, like fix those steps. The seller will fix it, no problem, right? However, something major comes up, like the roof is clearly in terrible condition, they're going to say subject to fixing that roof. And that may or may not break the deal. When we talk about more of the government loans, VA, FHA, USDA, also, they're looking more than just livable. They're looking for safety. And so, peeling paint is probably one that comes up all the time because, yeah, most people are like, oh, what's the big deal? Peeling paint, nobody's going to die. Well, there's lead paint issues, there's all sorts of stuff, right? And so you're going to have to repaint that. There's all sorts of other small things that come up that, maybe you wouldn't think it's a big deal, but in the eyes of the government loans, it's a big deal. And maybe Brian can speak to more of the things he's run into. But yeah.
So the big challenges are that with the loans, there's going to be kind of a tier list. Like I said, conventional, you can get away with a lot, not everything. I just closed a deal that had a very questionable roof, and the conventional loan terms said it needed a new roof in the next 2 months. So, conventionally you can get away with a lot, but when we're talking VA is really strict, FHA is pretty strict. I haven't had issues with USDA, and a lot of the rules can be kind of more severe on manufactured homes where they need like LNI to come out and confirm things. So a lot of items are going to be kind of heavily scrutinized. I think that one of my favorite ones I had recently was the house was beautiful, no problems, but the shed in the back had one wooden panel in the middle of the door that wasn't painted. So the only way we could finance the entire property was if the shed, who even knows what the shed's worth, $5,000, little tiny one, had that one panel painted. Otherwise, no loan. Deal breaker. And these types of conditional things can be really, really frustrating, especially for buyers, because a lot of buyers see a home like the one we were just looking at and be like, oh my gosh, the price is reasonable and the condition isn't that bad. I could fix it, like looking at this, like this wooden board, right? I know that this house needs more than just this one wooden board, but just something like this could make it unfinanceable. So condition is going to really matter. If there is a fixer, there are rehab loans. Do you know much about those?
Rehab loans? Yeah.
Mm-hmm.
I've dealt with a couple. They're not easy though. They take time to close, and you need to get all your paperwork straight.
My problems I've had with them is they take a long time. And oftentimes when people are looking at properties like these, if their budget is, say, $400,000, and this is not a $400,000 property, but let's say it was, they typically need to have a higher budget because they need to be able to do the repairs. The $400,000 maximum on a property like this won't work, right?
Correct.
So, you know, it is doable, but again, it's a budgetary thing, and it comes down to the condition. So if you are a first-time buyer, for the most part, it's probably not the best to look at fixers. It's typically best to look at a good home in reasonably good shape.
Yeah, I would also add it's going to take a minimum of 60 days usually to close one of those loans. The underwriting is just going to really go through like all your plans. They're going to go through blueprints. They're going to come back and forth. A big thing, you're going to have to get like contractor in place to kind of sign off on this, and the contractors aren't the best about communicating, and so it takes delays going back and forth, right? When it's just me and the borrower and I just need employment stuff, it's very easy, right? Back and forth, no problem. We close 30 days every single time. But man, when you involve contractors and all of this, you know, you're looking at 60 days minimum, probably, if not more. That you know could kill the deal. So yeah, unless you really want it, I wouldn't lean that way, especially the first time home buyer.
Contractors are busy people. Just break my everything. There it goes. Contractors are busy people, and it's really funny how you go, "Hey, can you do all this paperwork for me?" And they go, "Okay," and they'll get it to you, but it is not a fun process. It always sounds really exciting as people are getting started, but people get burnt out on it really, really easy. So in terms of like property conditions that I see most often, peeling paint on pre-1978 homes, broken windows, broken screens are also really funny because it's like the easiest thing to fix, but like broken screen, can't do it. Handrails, whether they're missing or whether they are just too big. I get too big a lot. Roof being near end of life or active leaking, like in my one picture. Exposed wiring, deal killer. I had one in a garage where the garage just wasn't quite wired right. It had like a couple of wires hanging, and that was deal breaker. Could not be done. We had to cut the wire, cap it to make it work, which again, easiest thing, but deal cannot close until that was done. Any type of moisture damage or active moisture, well and septic concerns sometimes come up, less so, but every now and then. Outbuildings kill me because a lot of times outbuildings are not even factored into the price. It's just a mossy old shed in the back. And like I said, manufactured homes are an extra level because of L&I. They very often need a ton of work, especially if a deck's been added. We just did one that had a deck and it was a whole thing. L&I went great, but it was a lot more work and a lot more heavily scrutinized, I think, than any other property I've ever worked on.
For sure. So, yeah, I think that moisture one is a big deal that comes out of nowhere a lot too. Evidence of water in that basement. Oh man, you got to get rid of that before the appraiser sees it.
Mm-hmm. So can buyers fix the repairs, do the repair themselves?
Can buyers do the repair themselves? I don't know. I've never seen a case where a buyer does that.
In my experience, not really, because they would have to do it like in escrow and like make the appraiser happy. Usually, again, unless it's a rehab loan, and then you're doing work and you might not get the house, right?
Yeah.
So a lot of buyers are like, forget it. It's like, not, is it doable? Maybe, but probably not, right?
Yeah, I think the big deal is you're putting funds into something you might not get a return on. Zero return, potentially.
Yeah. What happens if we do an appraisal and it comes in low?
Well, so in terms of the lender, I'll speak in terms of the lender's eyes, is that so the lender will only lend on the appraised value or purchase price, but they'll take the lower one. If the appraised value comes in lower, that means to the lender now, they will use that as the purchase price basically to lend on. So for example, if originally it was $1 million house and they were willing to do 80% LTV, $800,000 loan, however, the appraisal comes in at, I don't know, $500,000, God forbid. now, in terms of the lender's eyes, if you want to do 80% LTV, they're only going to give you $400,000. And so now there's this big disconnect between $1,000,000 and $500,000 that somebody's going to have to make up somewhere.
So more common than that much. It's usually more like $10, $20, $30,000, right? $5,000. So it's not usually that bad. Usually you're going to have to come up with some money. And again, the problem is that someone has to come up with the money. It's not that one party or the other. So for the transaction purpose, if there is a low appraisal, that's okay. Sometimes it can actually save you money. If you're like, hey, this is the max it appraised for, this is the new price. Sometimes sellers go for it. Sometimes it can save you money. Sometimes it can kill the deal if the buyer can't afford it or won't do it. The seller won't come down. It can. And then like in very niche situations, you can appeal appraisals, but for the most part, once it's done, it's done. It's whatever that appraiser said is what we got to work with. So they can be tough, but again, it's not the end of the world. It's a renegotiation point, right?
Let me add that reconsideration of value is maybe more prevalent than you think. Maybe the first time the sellers weren't great about fixing things, that kind of thing, or they didn't. I see this in refinances more than purchases, to be clear. That the first time an appraisal comes back and it's lower than they're expecting, and then the next time they send a reconsideration of value and then give different comps, basically, and then the appraiser comes back and raises it. I've seen it. I'd say at least 80%. About 80% of the time, it doesn't always go up to what you're looking for, but it will go up. So it's a possibility. It's not a dead deal immediately. Is basically what I'm trying to say.
Yeah, I mean, my challenge with it is it does depend on the loan type. And so, I know that certain loans can be more easily done than others. And sometimes there's a lot of personality in appraisals as well. And so appraisers and underwriters and things can have more issues sometimes than others.
100%. Yeah. It's a little tough to get an appraiser to raise the value because then you're kind of telling them, hey, you didn't do your job right. And so you don't say that directly, but it's kind of implied. And how would you feel if somebody told you didn't do your job right? Right. And so it's a little tough for sure, but it is possible.
So if we were to summarize in short, what do we want buyers to know before they reach out to you, and should they be worried?
In short, buyers should come to a lender and see what they qualify for very, very early in the process. Let's kind of get a credit score estimate. We can look that up online. If you're pretty high already, then we don't necessarily have to do a credit pull if you don't want to. But I mean, if you're on the borderline at 600 or 500 or whatever, then we should start thinking about doing a soft credit pull and understanding what your credit actually is, so that we can see if you can even qualify. On top of that, we should start crunching your numbers. If you're a W-2 salaried employee, it's very, very easy. We can just take what you make today divided by 12. However, if you're hourly, if you use bonus, if you're commission, we gotta crunch all those numbers and see what we come out with, so we can understand what you're qualifying and what your buying power is. On top of that, we need to look at your liabilities. We got to see what that DTI is based on your potential house you want. And all that, we throw it into a bucket, we mix it around, I do some math, and we come out with what you can afford, like the price you can afford. And that, in the end, will give you all the power in the world when you talk to Brian and he shows you houses, because then we can get you a pre-approval letter. Brian can get you a house. He can find you an amazing house, your dream house, and you together can go under contract, and then I will close it out for you and get you a loan.
And if someone wants to get a loan, where should they go?
You can email me, or you can start on my website. That's my website right there. Thank you, Brian. There's a contact us page in there. Feel free to fill that out. You can email me directly at joseph@openhousefinance.com. I'm always checking my email for sure. And you can also text me on my personal line, or actually it's my business line, sorry, at 206-321-7408. And I'm basically an independent broker. I do have a sponsor like all agents do, but I'm basically independent. I work myself and I work all the time because That's the only way to make it around here, right, Brian? Is you got to be
Absolutely.
answering the phone at all hours of the day, and I do for my clients. On top of that, I self-process like 90% of my files, so I am like very, very close to every single file and understand every single situation, and will respond all day and all night. So feel free to contact me.
So, in short, everyone, if you are thinking about buying a home, you know who to reach out to. Me and Joe. And if you need anything, we're always here. Normally ask questions, but we have pretty low viewers on this one. We got up to 6 or 10 people at one point. But for now, if you have any questions, you know what to do. We'll talk to you guys all soon.